the rights for the cycle from 2023 to 2027 have been sold at a whopping 44,000 crore rupees. It's a lot of money, high stakes battle like we said, and according to reports, Star has won the bid for the TV rights. They've paid around 23,500 crore rupees. It's a premium of 30% over the base price. Meanwhile, Viacom 18 has reportedly won the digital media rights, and this they've been able to take in at 20,500 crore rupees. And that is a premium of 70% over the base price. So that continues to be our big focus on India tonight. It's our lead story. It's something that we have been tracking, and we've been getting a lot of feedback from the industry about how high the bidding could go and what could be the final price. But look at where it stands today, 44,000 crore rupees. And this in a scenario where viewership of IPL has been successively going down. Despite that, we're looking at this battle now ending with Star taking the television rights and Viacom 18 the digital rights. And this for a substantial sum of money. While the IPL media rights continue to be our top story, the other big story we're looking at are the markets. What a bloodbath we've seen across all asset classes and equity markets. A quick look right now at what Wall Street is doing. The carnage continues over there, and we're seeing the domino effect across global markets. Now the Dow Jones has already shed over 600 points. The S&P 500 crawling back into bear territory. In fact, one could say that the bears have mauled the markets across the globe. In the United States in particular, investors have turned rather cautious, and this just ahead of the FOMC meet. It kicks off tomorrow, and we'll have a final picture emerge on the 15th of June. In our own markets on Dalal Street, markets have been pretty much mirroring the negative sentiment we're seeing across the world. The Nifty and the SENSEX both have suffered deep cuts. The SENSEX has plunged more than 1,400 points, and the Nifty has been down over 2.5% at the end of trade. All the sectoral indices have ended in the red in trade today. If you look at the sectoral picture, there's IT, oil and gas, there are auto stocks. These were the biggest laggards. They dragged the headline indices lower. In fact, other than the Nifty FMCG index, all the indices have plunged more than a percentage point. Even the broader markets have been bleeding, both the mid-caps and the small caps falling close to 3 percentage points each. Let's go across to my colleague Avan. She's joining us with a roundup of all the action that unfolded on the Dalal Street today. Avan, it's been quite a bloodbath, a manic Monday, and we've seen that mayhem across the Dalal Street. Tell us how things stood when we closed trade this Monday.
It was a manic Monday that played out on D Street, a vicious sell-off, and that can largely be attributed to the fact that U.S. inflation is at a 40-year high. Investors are very jittery ahead of the U.S. Fed decision. The dollar index is above 103, and FIIs are relentlessly selling. 15,774 is where we wrap the day after seeing a recovery from the low point. The Sensex nosediving 1,400 plus points. The broader market seeing a brutal sell-off, and no sector being spared the carnage. In fact, you had the PSU banking sector that was the worst hit, followed by media, metals and PSU banks. Within the frontliners as well, only 2 stocks out of the Nifty 50 holding out in the green. Names like Bajaj Finserv, Bajaj Finance, Tata Motors, Coal India, Infosys, even something like Reliance Industries and SBI succumbed to a bout of vicious selling pressure. Within the broader universe, RBL Bank took the heftiest knock, 23% in trade on the back of the new management taking charge. Brokerages downgrading the stock. Something like Suntech, Network 18, MRPL, Wellspun Corp, Tanla Solutions, Delta Corp and IBREL all saw a huge knock in trade. A significant market cap has been eroded. The Nifty Bank as well as the bank have breached some very crucial and decisive levels on the downside. And now we're staring at deeper cuts on the anvil owing to what the US futures have thrown up.
Thanks very much, Avan. That really puts in a nutshell what we've seen by way of market action in our part of the world. Now, just to understand the global picture and what one should be doing with our portfolios, what a retail investor's strategy should be at such a time when everything seems to be crumbling around us, whether we should buy, sell, hold. Let's connect with Deven Choksey, an old market hand, a friend, the Managing Director of KRCHOKSEY Securities. Great to connect with you again, Deven. Hope you're doing well. Now, tell us this evening, we're seeing the markets taking this mighty tumble. Is this the time to stay in? and buy, or perhaps sell and go away? What's your entire take? Because right now we're seeing these commodity prices, they're spiking. So I'm guessing you want us to stay away from anything related to commodities. But do tell us, what should one's attitude be to the markets right now?
Good evening, Vikram, and thanks for having me in your show. Well, I think this is not for the first time that we are seeing this kind of a nervousness in the market, a situation which has come because of, I think, variety of factors. The current fall in the global market, including emerging markets like India, is largely due to, I think, the collateral damage that the investor is now paying for. Because I think in various asset classes, I think they have started losing money. In fact, I think some of the investments I think that they have been having in the developed markets like USA, that has also started, I think, going down under, and as a result of which, I think the difference, I think, is required to be paid by the funds. As a result of which, I think the different other places in which I think they've invested, including, I think, including in debt, including in cryptos, including in commodities, crude, and even in equity, including emerging market equity. So each of these asset classes, I think they will have to withdraw money because I think they're incurring losses in other markets of the world. India, possibly, I think one can say that I think is relatively stronger economy, stronger market. However, I think the FIs and particularly traded funds are definitely, I think, finding the pressure of losses incurred in other markets and other asset classes of the world. That is the reason for which I think they have been withdrawing money every successive day from our markets. I don't think that the fundamentally we are so bad, but I think most of the businesses I think are now valued almost at a pre-COVID level, as I can see right now. And maybe I think this kind of valuations, whenever it has happened in past, I think has invited buying in subsequent period of time. So let's wait and see if this particular fall in the market is getting into a capitulation process. If it does, then definitely I think it is bottoming out in the due course of time and buying would emerge. So we'll have to wait and see, I think, if it does get into the capitulation process.
After the kind of real fear that we've seen through the pandemic, etc., now these economic fears, the possibility of a resurgence seem far away. Right now, there's going to be much more of the capitulation that you speak about. So within that, our approaches towards investments would have changed drastically. Are you seeing that? And if that really stands true, how do you align your portfolio to the current realities? The current realities are that crude prices are likely to stay elevated. We don't see an end to the crisis in Ukraine, perhaps. And there are so many uncertainties out there. So when it comes to the commodity universe, that uncertainty stands. When you talk about financial services, we've seen that kind of hit that has happened in recent time. IT stocks have been some of the worst hit in the session today, and we've seen that hit happen over a period of time. So when you're picking and choosing, what's the strategy that one needs to adopt? Are you seeing that markedly different from anything we may have done in the past?
So I think few rules I think we follow. The first rule is that I think the businesses which are directly impacted by the commodity movements, commodity price movements, I think it is safer to stay away from these particular businesses for the time being, because either I think those businesses I think could have a demand destruction, or this could have I think a significant amount of I think cost pressure coming in. This would include some of the industrial commodity products. This would also include I think companies which are consuming industrial commodities. So I think one will have to be relatively more careful about, I think, entering into those businesses. The second rule is that I think where the FIs have larger amount of holding, those companies, though they may not be fundamentally bad, including some of the frontline IT companies, I think they will face the pressure, largely because I think those FIs I think, who are required to withdraw money from markets, they will probably, I think, put pressure on the holdings that they have. And I think some of the frontline companies like HDFCs of the world, or even IT companies, I think frontline IT companies, they may possibly, I think, put the foot on the pedal and I think probably, I think, liquidate part of the holding. So this could possibly, I think, result into a fall. Typically, I think what we believe that I think the businesses which are remaining stronger in this environment are some of the large IT companies, the companies which are also having, I think, the IT as a backbone, digital as a backbone. I think they would also probably be doing well, particularly in companies which are operating platforms. And I think the more important part, the consumer credit and corporate credit business of banks and the NBFCs is definitely definitely, I think, remaining relatively more stronger compared to other businesses. So in this kind of a fall, when I think it accelerates, these are some of the areas where one would like to look at investing into the portfolios.
Deven, when you're looking at your portfolio, obviously the approach is the way that you would increase exposure, stay put, not take cash off the table. From the areas of portfolio that you may have, whether it's mutual funds or direct equity, how do you realign those? What are the best routes right now to invest, if at all you're suggesting any of the ones that we spoke about? What is the best approach to invest?
So those who are seasoned investors, I think they go direct equity. Those who are retail investors, they go mutual funds. There is no question on this particular aspect. I think the important point out here is that I think whether should you buy aggressively now or should you gradually buy? Because I think the situation remains quite fluid. Maybe I think the first quarter results are also likely to be impacted. And as I see it, I think the second quarter is a time when I think markets probably would start stabilizing after a due process of capitulation, if at all it takes place. So in such situation, I think your buying should be gradual. Your approach should be stock specific, and individual companies where I think the fall is sharper and the valuations have become attractive enough, I think those companies can be given first preference to gradually add them into the portfolio. And as I mentioned, I think we see the possibility of, I think, capitulation. In this capitulation, unrealistic prices can also happen. And given that kind of a possibility, the investors who are receiving their dividend income checks, investors who are basically sitting on cash, they would get an opportunity to buy from this market at a lower levels if the market enters into capitulation state. So in that kind of a situation, I think you should be selectively buying the frontline stocks. My reading says that I think at this point of time, mid cap and the small cap stocks would remain most vulnerable. They may have, I think, some amount of a slowdown also impact, and they may also have the margin impact also. So would rather stay with the leaders in the pack, and I think in the frontline space, where I think the market price gives an advantage to buy at a lower price. One should look at, I think, then for adding into the portfolio.
Deven, on a daily basis, we are seeing global markets. See what's happening on Wall Street right now. It's about 2.5% down the Dow Jones. The Nasdaq is down by about 4.25%. 3.5% down on the S&P 500. These are big knocks that we are talking about. These are the kind of news that you're hearing on a daily basis. Now, on June 15, the Fed gets into a huddle, and they are going to really decide how they're going to set rates. So looking at the kind of news flow there is from outside India, which you said we've been fairly resilient as an economy. Our markets are holding much stronger than many of the other markets. But there is going to be the domino effect. How do you digest this kind of news coming in? Because this can easily rattle you.
Yeah, you are right, I think. But as I started saying, this is not for the first time that I think we are seeing this impact. We are globally connected. If some countries are facing a situation of depreciated currency, they would invite sell. If some countries are facing a situation of, I think, current account deficit, they would invite sell. If those countries, I think, which are having a problem of, I think, attracting the new investment, they would invite sell. And where I think they have got, FIs have got a larger amount of positions, particularly in the traded funds, they would invite sell. So yes, I think you are absolutely right that domino effect kind of a situation can definitely happen. And for a country like India, which is basically promising to grow at 7.5% GDP growth, the country, I think, compared to other developed nations of the world, I think would have relatively smaller inflation comparatively. I think is still exposed to this kind of vulnerability and a fall. As I mentioned, I think this kind of a fall or a crack happening in the market due to variety of reasons which are not necessarily driven by the fundamentals, I think they could possibly give an opportunity to investors at a lower price. And that is a time where I think probably you have to come forward. As I see it, I think somewhere in the second half of the financial year, considering the fact that I think we might see some positive news on the crude oil front and I think commodity front likely in the second quarter of the financial year, I would think that I think you will probably see in the second half of the financial year, the market stabilizing. And at that point of time, I think you should have money to probably, I think, stay invested. At the same time, I think buy at a lower level. So one will not have to panic at this point of time. But reality of the situation is that the market could come down. At that time, I think one should be ready to buy.
the Indian rupee in recent times bother you? It certainly does when it comes to our FIIs and FPIs, which are taking flight. But do you see that as a worry area?
The FIs and FIs have, I think, compulsions to sell. I think when they see the currency depreciating, they will sell. When they see, I think, their losses incurred by them in different other markets of the world, I think they will sell. If they see, I think, losses incurred in, I think, different other asset classes, I think they'll sell. So I think they have different compulsions under which they sell. And unfortunately, globally, the FIs, I think, these days have been operating significantly into the ETFs. ETFs are those funds, I think, which are basically not connected directly with the fundamentals, but they play largely on quant and algos. So as a result of which, I think this kind of FIs would probably sell. Coming to FPIs, I think FDIs, I think my reading says that I think the FDIs probably will continue to invest in India. Government of the country has allocated significant amount of money towards the infrastructure projects in the current financial year. The new PLI schemes are also having a character of attracting a lot of new investment into respective industry verticals. So in my viewpoint, I think the direct investment, the foreign direct investment will come into the country, and that is going to save the currency from going down further. I think I would remain cautiously optimistic at this point of time in selecting my investment options, and probably I think stay invested, because I believe that second half of the financial year onwards, I think market would not only stabilize, but 23-24 end of financial year would probably also give you a good amount of opportunity to get a reasonably handsome return from the lower base.
We seem to have lost connection with Deven, but that sage advice that he gave isn't lost on us. Stay invested, stay cautious. If you do stay invested,